Okay, guys. Um, Most likely you watched the short-term trading video on the Market Maker series, and just to quickly summarize the things that we discussed in that particular tutorial, uh, because it's going to be germane to the discussion as it relates to day trading, my concepts. Now, short-term trading, the duration of the trade is anywhere between 1 to 5 days. Now, contrasting that with a day trade, obviously, as the name implies, it's a day trade. The trade that you take and execute an entry in the same day you enter, same day you exit. The approximate number of pips in a short-term trade is 50 to 150 pips. Intraday trades can range anywhere between 25 pips, 15 pips, as much as 100 pips. Okay, on a real big barn burner day, you can get over 100 pips or so, depending upon the type of magnitude and volatility that's available for that particular pair in that day. Optimal setups for short-term trading are in sync with the daily and 4 hour. Now you're going to see that the highest probability for successful day trades are going to be very similar to those conditions as well. And the time of day is sensitive for entry and exit, as you may have already expected. Now, the structure in which you work within to frame the ideas that you're either going to be buying or selling any of your pairs or asset classes, depending upon whatever market you're trading, because this is not limited to foreign exchange. But we start with the daily chart, and we're focusing more specifically on the daily for overall market structure, key support and resistance, and institutional order flow as it relates to order blocks and liquidity voids and liquidity pools. The 4 hour, we're specifically looking at the daily and 4 hour order blocks and liquidity pools. Where are the stops? Because where the liquidity pools are, that's going to line up for your future turtle soup entries. And we'll talk more about that as we get into this particular teaching. And 15-minute is for timing. We're looking specifically at the time of day, ICT kill zones in the London Open, New York Open, and we're specifically aiming for first returns to the order block. That is the other trading pattern that we use. So we're limiting our trades to just two patterns. That is the turtle soup, false breaks, and the optimal trade entry return back to a order block for entry. All right, now for day trading, obviously you guys heard me talk about this many times in the past, and you're going to hear it again just because it's that good. When we look at a daily range, the daily range is going to be the primary decider on whether you're going to be a buyer or seller on a particular day. And the reason why is because the daily range is what you're trying to capitalize in. That's the nature of day trading. We do not like to force ourselves into creating a long-term trade out of a day trade. So if you're going in with just a day trader's mindset, um, expect to take the lion's portion of your trade's profits off at a pre-disclosed time, and that being the London close time period, specifically the 1500 to 1600 GMT. Okay, or I average anywhere between 10 o'clock in the morning to noon in New York time. Okay, so that's kind of like the sweet spot. I like taking my profits in the 10 o'clock to 11 o'clock in the morning hour in New York time. That's like, to me, that's where the actual high or low forms and then starts to have a little receding back into the range beyond that particular hour. Now, does it happen always? No, but by far and large, you're going to learn if you start studying the price of any asset, it's going to do that very thing. Now, your primary function as a day trader is to determine whether you're going to be a buyer or seller for the day. Now, I'm not talking about scalping. I'm not talking about going in there for 5 pips and 10 pips and 15 times a day. I'm teaching you how to load up and wait for specific times of the day where you get one shot, one kill intraday setups. You get one shot, one kill in London. You get one shot, one kill in New York. After that, you move to the sidelines and you wait for another day. If it doesn't set up a parameter for you to take another trade the following day, you sit and wait. Okay. Now, for a buying condition, obviously we expect the open to be very low in the lower quarter or 1/3 of the average daily range, and we expect the close to be higher than the open. Okay, that's all you need to be profitable in day trading. the amount of distance between the low and high is going to be very respective of the average daily range over the last 5 days. Now there's tools and indicators that are out there that are very easily found. I will be adding them to the tutorial page you viewed this tutorial in. At the bottom there's going to be a zip file, and I'm also going to have an individual itemized list. You can actually go in and pick the very one you want, so that way you don't have to go through the whole zip file. But I will create a zip file for everyone that has an interest in all the things I use for MT4. None of them were created by me. Okay, so these are all things that I've collected over my years in the foreign exchange, and I've got them all over the place. I can't really remember where I got everything from. Some of them are actually emailed to me by friends and subscribers to my group, and I'm very thankful for that. And some of them actually were created by some of my subscribers. So I'm gonna leave that for now. I would love to be able to find out who was the author and creator of some of them, because I want to give credit where credit is due. I don't want to assume or let anyone think that I created these things, because I did not make them at all. Okay, but I do find them valuable if I'm using them in my MT4 presentations. So now when we look at an open, high, low, close bar, okay, this is what I want you to think of, okay, because it's the accumulation, the profit release portion of the daily range, or the expansion up making the high, and then there is the distribution intraday. Well, when we see that, okay, that is very predictable when it comes to trading price patterns. And one of the price patterns I love trading is turtle soup. Now, turtle soup, you hear me talk about a lot in my videos, is not a pattern that I created. It's not something I came up with individually. Years and years and years ago, I bought a book, as you can see here. It's titled Street Smarts by Larry Connors and Linda Raschke. And one of the patterns in their particular book I love very much. It's called turtle soup. I'm not going to go into details and steal the thunder from the book, but I will tell you this. It's a pattern that trades a break below a low. Okay, in other words, if it's a swing low around an area, near an area when you'd expect a low to form, but not quite so uh, precise in terms of, for instance, if we had an order block just below the marketplace and it had already created a swing low and starts to turn around a little bit. What I like to do is I like to wait and see if that initial low is breached, and as soon as it's breached and trades into an order block on a higher time frame, I'm all over that bad boy on a day trade or a short-term trade. But specifically for day trading, if this occurs during a trading session like the London Open or the New York Open kill zone, as it relates to ICT concepts, that being London Open is 2 o'clock to 4 o'clock in the morning New York Standard Time. The extended ICT kill zone for London is 1 a.m. to 5 a.m. So you kind of bracket out those hours, but the sweet spot is generally between 3 o'clock in the morning to 4 o'clock in the morning. You'll find that that's many times the very high or low of the day. New York Open is generally a condition in the market where you see a continuation of whatever was placed in the market directional wise in London. There's usually a continuation of that in New York. Now the times it's not going to be a continuation, when it gives you a reversal market profile, in other words, it may have moved like 60, 70, 80 pips in London and gave you a very nice sell-off or a rally, but then it hits a higher time frame order block. Then at that moment during New York Open, what will happen is you'll see a market reversal profile, and the market will turn on a dime and go back the other way, and many times retrace the entire London session move and go beyond it and go lower or higher in deference to initial London drop, and then the reversal in New York, creating a rally that goes beyond the high that was established in London. So that's why it's important you have a higher time frame respect of your charts, because if you don't keep that in mind, you're going to get nailed by these intraday market reversals. Now, as you can probably guess, the turtle soup on the reverse side is a break above the high, and we'll talk about that as we get to it. But most everyone that's familiar with my concepts in day trading, especially as it relates to